Hi everyone, JR with Secure Metals, bringing you a research video here for the week ending June 13, Friday, June 13, 12:57 p.m. Eastern Standard Time. This will be a research video. The analysis video here will be on the next video that'll be coming soon. And of course, as always, all the articles mentioned in this video will be in the bottom of the, we're actually at the link below here. So I'll start the video off with this quick quote here by Thomas Jefferson, and you'll see why in a minute. I believe the banking institutions are more dangerous to our liberties than standing armies. If the American people ever allowed private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around will deprive the people of all the property until their children wake up homeless on the continent their fathers conquered. The issuing powers should be taken from the bank and restored to the people to whom it properly belongs. No central bank should be printing money. Money should be something that consumers compete for, and good money is always sought out. So no reason whatsoever for a bank to control. And the reason why I put this quote here is because I think inflation is a big problem that we obviously have here in the U.S. and across the board, across all nations. And really, it's a policy. It's not at all something that comes natural. You see in a couple seconds here also as well. And I think also it shows the intelligence that these founding fathers had. They really knew what they were talking about when they set out to write the Constitution and the Bill of Rights, which, by the way, again, grants us no rights whatsoever. What it does is it limits the ability for the government to intervene in your rights. Now, look at this article here. Central banks' inflation is God's work. Again, the link will be at the bottom. Inflation has always been someone else's fault. Ludwig von Mises called out the finger-pointing central bankers and politicians decades ago in his book, The Economic Policy. I have a copy of this book. Great book. You should definitely read it. If anyone wants a copy, give me a shout. The most important thing to remember is that inflation is not an act of God, that inflation is not a catastrophe of the elements or a disease that comes like a plague. Inflation is a policy, right? It goes on to say how Gideon Gano from Zimbabwe blamed inflation on the differences that Zimbabwe had with its former colonial master, the UK. He then added, we are busy laying out the foundation for a serious deceleration program. At that point, inflation was at 4,500%. I mean, unbelievable. We are busy laying out the foundation for serious deceleration program. Deceleration, a year later, inflation was at 231 million%. I actually have some of Zimbabwe's currencies. I have a few $10 trillion bills, a few $50 trillion bills, and a couple of $100 trillion bills. That's what happens when you inflate. Money printing did not have anything to do with it, according to the central banker. Droughts began to be more frequent in the year 2000, and Gano believed there is a positive correlation between the drought and inflation. Dry weather, he told African American magazine, he told New African magazine, got serious bearing on our inflation levels. Now, these days in Argentina, it's not the weather and political sanctions causing prices to rise, it's businesses engaging in commerce. So now the government is blaming businesses for the inflation. President Cristina Fernandez is urging her people to work elbow to elbow with her government and stop companies from looting the people with high prices. 2 weeks ago, the government devalued the peso by 20%, but it is private businesses that are stealing from working people with price increases. Posters of retail executives have been plastered around Buenos Aires. For instance, Walmart Argentina's president, Horacio Barbeito, has his mug on a poster with a caption, "Get to know them. These are the people who steal your salary." Unbelievable. And it's always something new. So again, I urge you to read that article. Very cool article. Okay. Now, talking about inflation, right? Talk about inflation. Now we have this to deal with. On last week on Wednesday, The ECB announced that they're going to bring down interest rates even lower, bringing interest rates to a unprecedented negative interest rate. Okay? So this is a great article in the Mises Institute. Negative interest rates, only the start. Okay? As Ryan McMakin noted on June 5th, the European Central Bank has instituted negative interest rates for member banks. This could soon spread to the US and also to consumers' accounts. If so, you would find money taken out of your bank account each quarter unless you spend it. Some observers think that the US, at least, it will start with higher account fees, which will be stealth negative interest rates, and then move to overtly negative rates. The idea is that if low interest rates are not yet persuading you to spend, then why not punish you even more for saving? To make this more effective, there would also be a push for all electronic money to keep you from stashing any away from the confiscation agents. Ken Rogoff, a lead Harvard and Republic economist, has just recommended this to facilitate negative interest rates and, in general, to increase government control over cash. This is far from the only innovation that could be coming our way. In a speech on June 4th, San Francisco Fed Chairman John Williams suggested that the Fed should at least take a look at nominal income targeting. He said this could be a creative way to bend the curve in terms of macroeconomics and financial stability trade-offs. What this gobbledygook means is that the Fed would simply create money and then distribute to parties in dangers of bankruptcy and foreclosure. Isn't that a great idea? Why stop with the bailout of big banks when you can bail anyone out who gets in financial trouble? That would guarantee the zombification of the economy that is already well underway. Bad businesses, ideas, and badly managed companies would live forever at the expense of good ideas and well-managed companies. Here are some of the draft ideas being discussed in central banking and other circles. Take a leaf from Japan by forcing banks to lend in return for Fed support. Hold interest rates down, but simultaneously drive inflation up to as much as 5 to 6%. With real interest rates at -5, borrowing will soar. What isn't clear in this scenario is why lenders would want to lend, but they can always be forced to do so. Create even more money and use it to buy corporate bonds, stock, real estate, anything that can be bought, which will flood the economy with money. Some of the ideas waiting in the wing are not monetary. They include: the government should set an annual borrowing target for the economy. Wow. If it isn't being met by the private sector, the government will itself step in and borrow to achieve the target. Who cares how the borrowed money is spent, so long as it is spent? The government should issue bonds that will never be repaid, not simply replaced with new bonds at present, never repaid. Employers should have to seek government permission to lay off or fire workers. This idea of Paul Krugman's, we all love Paul Krugman, is already true to a large degree in France, with the result that the employers are very reluctant to hire anyone. These days, government economic managers are like mad tinkers. Aldo Leopold said that the first rule of tinkering is that you don't throw away the parts, but the Keynesians, PhDs, in charge of our economy are dissembling the economy at too fast of a pace to listen. Okay, so no bueno here. Negative interest rates. That'll be fun here. Okay. On to the next article. Now talk about an economy doing well. Talking about an economy doing great, because apparently the economy is doing great. I mean, look at the Dow Jones. The Dow Jones. I mean, like I said, I've said it before. Look at that. Look at this. Unbelievable. You hit a peak, and I mean, this is bad right here, right? Found a little bit of support here, moved to the upside a bit here, and just came down, broke through that support. Now the next level is somewhere around here. But point is, Dow Jones almost hitting 17K, 16,971 was the high. Unreal. But I don't know, I guess it makes a lot of sense. I mean, look at this article here. Explaining New York's record homelessness in one disastrous chart. The link for this will be below. I don't want to spend too much time reading more articles here. But again, I think this shows it all here. In 1983, you had less than 15,000 homeless in the city of New York, in New York shelter system. By the year 2014, I mean, we're at record-breaking 53,615. And apparently the economy is doing well and we are recovering, okay? I think the recession has already started, if you ask me, but who am I? Right, I'll have the link below to this one also. Great article, you should check that out. Because, again, what a disaster. Record homeless in one disastrous chart. Yep, that's it right there. What's next here? This was a week ago, all right? This is how great the economy is doing. Consumer credit has the 5th biggest monthly jump in history. Revolving credit soars by most since 2007. Consumer credit back in 04, 26 billion. 05 to 09, the peak was 80 billion. And here we are at 100 plus, roughly maybe 160, 170. A month ago, we pointed out that with April's U.S. consumer savings plunging to levels not seen since Lehman, the only place where the tapped out consumer could find some purchasing power is by maxing out their credit cards. This is precisely what happens. Moments ago, the Fed released its April consumer credit report, and it was a doozy, expected to print $15 billion down from the previous $17.5 billion. The April's total instead exploded to a whopping $26 billion. This was the 5th biggest surge in history. Again, another great article. You should check that out. Great recovery we got going on here. All right. I also wanted to show this quick chart. Global reserve currency since 1450. So Portugal, back in the 1400s, 1500s, they had the reserve currency for roughly 80 years. In the 1600s to the 1700s, 110 years, Spain had the reserve currency. The Netherlands had the reserve currency for another 80 years. France had the reserve currency for 95 years. Britain has had the reserve currency for over 105 years. And roughly in around the 1920s, 1930s, after World War I, the dollar began its way to being the reserve currency of the world. And so far it's been I think officially it was in 1970 or something like that we became the reserve currency, or in the 60s, I think. But my point is that this is most likely going to come to an end, and I think with the creation of the BRICS, which I went over in my last video, BRICS being Brazil, Russia, India, China, and South Africa, as being the BRICS nations. They no longer want to use the US dollar. And I also spoke about the deal that China and Russia were considering. And this is the deal, the signed deal. Russia and China signed deal to bypass the US dollar. In a symbolic blow to the US global financial hegemony, Russia and China took a small step toward undercutting the domination of the US dollar as their international reserve currency on Tuesday, when Russia's second biggest financial institution, VTB, signed a deal with the Bank of China to bypass the dollar and pay each other with domestic currency. The so-called agreement on cooperation, signed in the presence of Chinese President Xi Jinping and Russia's Vladimir Putin, who is on a visit to Shanghai, was followed by the long-term awaited announcement on Wednesday of a massive natural gas deal. 10 years in the making. The deal is for $400 billion and is for 30 years. You should read the article. Great article here. Okay? The US dollar is in a lot of trouble, guys. Let's see what else I have. No drinking water for Venezuela because the bankers need it. Again, deflation and inflation. No drinking water in Venezuela until bankers get paid. All right? 2013 was a good year for Goldman Sachs investment in emerging markets, most notably in Venezuelan bonds, as they bet on socialism and won a year later, and Goldman Sachs' emerging market debt portfolio is still loaded with Venezuela bonds. And the arrears are mounting, as Bloomberg reports, at a time when Venezuela's record $25 billion in arrears to importers has its citizens waiting hours in line to buy drinking water and crossing borders in search of medicine. President Nicolas Maduro is using the nation's dwindling supply of dollars to enrich bondholders. Okay, the banks are more important than the people. All right. The last thing I'm going to show here is this. This chart shows the gold prices as well as the oil average price per year, right? Since 1946 all the way down to 2013. I don't have an average price for this year just yet. And so this is how it works, right? So at least in 1930, we had a partial gold standard, and we can very easily see that when you have a gold standard, at least a partial gold standard, you have a fairly stable currency, not too stable, but it's fairly stable. And we can see that from 1944 to probably 1969, let's call it 1967. From 1946 to 1967, your price of your ounce of gold was roughly 34 to 35 bucks. Jumped to 39 in 68, 69, 41 in 69, 36 in 70, and 71. We saw an average price of $40.62. And this is when we took off the gold standard. And look at this. I mean, from $40, 58, 97, 154. I mean, every year it just goes up. And you do have some corrections. And again, this is not a chart, but again, we get the picture here. I like charts better, but 1982. So you do have a couple fluctuations. In 1981, the average price was $460. 1980, when gold peaked at 800. Or at 800, you had an average price of $615, and what happened is again it just continued to go higher and higher and higher and higher, and this is a scary scenario because look what happened in 2010, 1200, 1500. So I think we can see that there's a trend here of higher average prices for the precious metals, right? No reason to believe whatsoever that this is going to start going down from 1,500 to 1,200 to 1,100 to 800 to 500. No reason to believe that whatsoever. Now, these are your average prices of crude oil. From 1946, you had a fairly flat price up again till 1971. Price of oil fluctuated from $1 all the way up to $3. So just a $2 fluctuation and a $2 fluctuation here also. So for about 25 years, I mean, it was fairly flat and fairly stable. Again, look what happened in 1971. It starts going from 30.60 to 4.75, 9, 12, 13, and it just keeps going up and up and up and up. And you had 2008, 2008, $91 for a barrel of oil. That's the average price. I think the high was at $150. A little bit of a correction, but there's no reason to think that this is going to start going back down. We can see crude oil prices taking off hard within the last couple of weeks, and no reason to think that this is not going to continue to trend, right? Now, this is how many barrels of oil your ounce of gold can buy you. And the reason why I'm showing this is to show the stability of gold and silver. So the fluctuation between the dollar and oil has been $150, or let's say $149 if the peak was at $150. I forget what it was. But my point is, at one point you can buy a gallon of gold, a barrel of oil with $1.63, and today is at $87. That's the average price. But the fluctuation has been from one to the highest point, which was 91. So basically a fluctuation of roughly $90. So at its low, it was buying you $1. At its high, is buying you its cost $91 for a barrel of oil. Now, if you calculate it in gold terms, right, at its low, it's buying you 9. At its high, is buying you 29, right? So only a fluctuation of $20. And that's what you call stable. That's a stable currency. So within 40 years, actually in 60 years, the gold to oil ratio has only been a fluctuation of $20. So you have a fluctuation here of 90 and a fluctuation here of 20. I think gold is a lot more stable than the US dollar. Guys, get yourself some gold, get yourself some silver. These guys are just going to continue to experiment with this economy. We are the guinea pigs. Whether they get it right, it does not matter, because if they get it wrong, all they'll do is repossess all of everyone's assets. That's what inflation and deflation is, because just the thought of printing money is inflationary if you have unlimited means to continue to print. Okay? And that's about it, guys. I hope that put things a little bit in perspective and how governments work, and why the Constitution has so many restrictions on the U.S. government, and why it is so important that we stick with this Constitution and take the powers back. Until next time.